This program is sponsored by Wilsey Asset Management.
Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, good morning and welcome to the Smart Investing Show. I am Brent Wilsey. Thank you for tuning in this morning. Started the investment show, Smart Investing Show, about 28 years ago with us. Here we talk about finance, investing, the economy. Done that all these years. Really built a very good listener base here. If you're looking at a stock or an equity and you want that unbiased, no strings attached, fundamental opinion on the stock that you are looking at buying, selling, or holding, give us a call here at 866-577-2473. That's 866-577-2473. And that'll get you through, as I said, for that unbiased, no strings attached, fundamental opinion that you want to talk about. Chase, good morning.
Good morning.
I made a huge mistake this morning.
What was that?
I took a bite of this bar because I was hungry. And, you know, you got that rush of taste in your mouth. And I'm trying to talk. And I couldn't quite get it out very good.
You got to be careful with those.
I know. So I got to wait for you to talk, so I'm taking another bite. So, but we do have a lot of things to talk about. Still happening. That bar is still like, gosh, it's lingering. It is a Reese's Crispy Crunch. Not very healthy, but gosh, the flavor rush just keeps coming and coming.
Should have ate that while you're. Oh, you don't eat in your car. That's
no,
right.
you can.
Yeah.
I never eat my car. I've thrown people out of my car for trying to eat my car. Like, nope, get out. You're eating in my car. But we do have a lot of things to talk about today. It's less than 2 weeks now for the workshop.
Coming up. I know last week you had a little trouble determining, is it 2 weeks, 2.5? We know now it's less than 2 weeks.
Less than 2 weeks, yes. It is going to be Thursday, June 24th at 6 o'clock. It will be held at the Ale Smith Brewery right off of Miramar Road. That's where we'll be having the next Smart Investing Workshop. You know, at the workshop, you know, we actually do show you what we do and what I've done for the last 40 years, how I've built the business. And actually, I spoke to, gosh, I think it was like 100 realtors from Century 21 this past week on how I built, my business and how we do that. And it is because of how we manage the money. And that's what we show you. We don't hold back. We show you everything we do. We talk about things, mistakes that you could be making. But the important thing is that you got to sign up. Seating is limited. I think we're about, almost more than halfway full. When I talked to Brianna, I think we're about more than halfway full. So don't delay. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. You'll see it there right in the front page. Click on that. Sign up there. If you want, you can call the office, 858-546-4306. That's 858-546-4306. Talk to Brianna. She'll get you signed up. And we look forward to seeing you on Thursday, June 24th, 6 o'clock at Ale Smith. And I was at the Hop Shop, I think it was.
Hop Stop
in Poway. And they had one of Ale Smith beers there.
Oh, yeah.
Yeah. And I don't know what it was, but it's pretty good.
Yeah.
Yeah. So people can drink beer while they're getting smart on the investment side.
Yeah, no, definitely.
The beer's not free, though. The workshop's free. The beer's not free. All right. Let's talk about this past week here. A lot of things went on. Oh, okay. Yeah. So I'm still going. Oh, shoot. Where's
I'm a little slow this morning, huh?
Yeah. I'm just like all discombobulated. Okay. I'm looking for, and I know we talked about, because we have so many different things to talk about, we kind of prioritize ours. And I can't find a sheet that it was priority, but I think I have it.
Okay.
JOLTs is what
that's where we're starting.
Let me kind of get that out. The JOLTs, which stands for Job Opening Labor Turnover Survey, very important. This economy has so much potential as we continue to come out of COVID. It's just unbelievable. Driving in today, I saw all this traffic. Like, I had to slow down below 75 because of so much traffic. Part of this can be seen in the job market, where employers continue to be desperate for workers, and this is so true. In today's JOLTS report, actually, it was I think it was on Thursday came out. We saw job openings, and I could not believe this when I saw this. I thought, is that a mistake? But job openings hit 9.2 1.3 million people.
I mean,
Opening.
it's insane. I mean, that is a lot, especially when you actually look at the relative numbers. The estimate was actually for 8.3 million, so we blew that out of the water.
Yeah.
And then also last month, the openings were also 8.3 million. But the thing is, 8.3 million, yeah, that sounds like a lot. That was a record, was 8.3 million. So 9.3 million, that's a new record by 1 million jobs. That's a ton of job openings. I mean, we've never seen anything like this. I mean, it is insane, and it really is evidence that the jobs are definitely out there. And I do hate to say it, but I do believe the elimination of the enhanced unemployment benefit will result in more people filling these jobs. I mean, the jobs are out there, and the people are unemployed. There's definitely a disconnect, and this is one of the factors that I think is holding people back.
And there's no doubt in my mind that's what it is, because you talk to people, and I talked to somebody last week, and he goes, my daughter, she's a real hard worker, but she goes, Dad, I make so much more staying at home than I would if I went to work, and I just can't, financially. Well, why should I do it? And again, this is somebody that does believe in work and so forth, but it's just it is hard. And then you have employers having problems because they want to get people. And you go to restaurants sometimes, gosh, the service is slow because they don't have enough people. I was listening to one of our conference calls yesterday from one of the companies that we own, and they said it's not only workers not being there, but people calling in sick a lot.
Yeah.
So, I mean, there's a lot of difficulties for employers right now, and the demand is out there. And I have thought about this. Is the demand so high because people are collecting unemployment and these stimulus checks, staying home, and therefore they have nothing to do, so they go to these businesses? Wow. Well, will that change a little bit when people go back to work? Maybe.
Yeah, it could happen. I mean, I was reading a conference call from a potential company we're looking at. It's actually a restaurant chain. Mm-hmm. And, I mean, they're just talking about how the demand has come soaring back. They also do believe that their delivery business will be elevated in terms of pre-pandemic levels. They're thinking that things will return and be even better than they were prior to the pandemic because now they have an enhanced delivery business and think that the people want to come back to eat. So it is an interesting point is, well, is the demand so high because, well, people don't have anything to do right now? It's like, well, I guess I'll go to lunch. I guess I'll go shopping. Is once people start having jobs, are they going to still want to go out as much?
Yeah, and they may not, because I know, like, at the end of the day, and I put them, I start pretty early and finish. I'm kind of tired by the end of the day, and sometimes, yes, we will go out, but a lot of times I just want to go home and, have a nice dinner, a glass of wine, and kind of, sit there, maybe do some reading and, call it a day. But I think the part of that is true, because if you're not doing anything all day, you want to get out, you want to do something. So that could change a little bit, but still, I think people that are working are in better mental states, I guess I'll put it that way.
Yeah. So I mean, we'll see what happens. I do continue to anticipate, and this is kind of further proof that the economy will continue to improve, especially on the job market side over the next few months. I mean, the unemployment will come down. People are looking for employees. It's not like, we're going to pull back. It was a completely different story last year where companies like, we have no idea what's going to happen with COVID, so we're not looking for employees. Now, no, we're looking for employees. We need people back.
And what will be the test, too, is that I think 3 or 4 states already cut back on or eliminated the extra unemployment numbers from
last week.
Yeah. So we're going to start seeing how that happens with those states. Does their employment go up? I mean, so we're going to start getting some numbers here coming over the next couple of months. It's going to take some time to get those numbers. But there's no doubt in my mind. I mean, if you stop paying somebody so much, well, I got to go to work now. So
the problem is, I continue to believe, is California and New York are 2 of the most populated states. Yeah. So it can continue to weigh on the federal unemployment numbers. So it's going to be interesting to look at a state-by-state breakdown to see what is actually happening there.
And I meant to look this up, but I went to breakfast on Thursday morning with Governor Ron DeSantis from Florida. I thought I heard that Florida now has a larger population than New York, and I don't think that's true, but I meant to look it up, so I wouldn't be surprised. I know a lot of people, and he talked about it. He goes, and I'm really surprised about people leaving California to come into Florida because he didn't admit our weather's better here than there. But I'm just wondering how big Florida is now. So, but maybe it will be New York, Florida, and California will be the 3 big states.
I think Florida's already up there, and Texas. Florida and Texas are 2 heavily populated states as well. So I don't know. We'll see what happens. I mean, I do think it's going to be important to kind of look at these numbers as they do come out over the next few months. And I think by, say, October, November, I think you're going to see that unemployment fall quite substantially.
Yeah, I think so too. Let's move on and talk about, it almost looks like memo investing, but it's meme investing is what it actually is. But don't look now, because the risk of investing in these meme stocks, which we have talked about for months now, can't believe it, it's gotten even worse. We looked at the option contracts tied to the movie chain, AMC, which is really pretty hot right now. Last week, they totaled $11.6 billion. Now, keep in mind, yes, that's a lot of money, but let's put it in perspective. That is more than the S&P 500 Spider Trust, the Invesco QQQ Trust, and Tesla Incorporated combined. That's more options than those 3. Again, just shows you how crazy this is. And the thing that we need to point out is that these people are trading that. They have no idea how options work.
Well, and I'm going to say, too, is when the year started, AMC was worth, I think, a couple $100 million was their market cap, not their options trading. And even now, too, if you look at AMC, I want to say their market cap somewhere around $20-30 billion. $11.6 billion in options, so over a third of the market cap. And, I mean, that is insane to have that type of volume on site. It just shows how ludicrous and how crazy this is. And I do fear that many people gambling with these options, again, they don't understand the rules of the game. They don't realize that when the option expires, they lose 100% of their money. Please remember, this is not investing. This is gambling. If you don't want to lose your money or can't afford to lose your money, stay away from this craziness. And I worry, too. You even look at the naked options. I mean, you could be really setting yourself up for failure if you have to put a stock to somebody, let's say.
Yeah.
And you don't own the stock. Well, now all of a sudden you have to put the stock. You got to come up with the funds to buy the stock to put it to that person. I mean, it's dangerous.
Yeah.
And people, I think, they think they're being smart. They think they're making all this money. Oh, my friend Joe, he made $10,000 off trading AMC. Like, I want to make money like he did. And all of a sudden it becomes a huge problem.
Yeah. I guess people, we don't have Facebook working today. Social media's not working. So just kind of let people know that if they're trying to listen to Facebook or trying Facebook, not going to work. They may not know because they're not on Facebook.
Yeah.
But anyways, and they don't realize that the things, and that's a problem. They just think it keeps going up and up and up, and we're beating the hedge funds and so forth. They don't realize that there's this game being played, and for every option, you've got to have, and the option's 100 shares. You've got to have the stock there because eventually you need to get that stock. So you can't. It's just strange what is going on here. I would not be surprised if there's some major problem with the options market on this, that perhaps there's some where there wasn't enough shares or something. Something could happen and have this whole thing blow up, because it's just, again, $11.6 billion, and that was a week. This is what's going on. It's just, and I had a guy say, we should have bought AMC back when it was like $5 a share. It's like, no, there was no reason to do that. Would it be great?
They were on the path to bankruptcy if this didn't happen.
Yeah.
The only reason they're able to survive, or not the only reason, the reopening has helped them, but one of the only reasons they're able to, because they were able to issue all this stock to take advantage of these high prices. Yeah. That's how they're actually going to be able to get through the liquidity crunch that they had. I mean, it's just ludicrous, and nobody could have predicted this.
No.
It's insane.
And the other thing too, it's creating, like, people are like, oh, I'm smart, I know what I'm doing. It's like, no, you're riding the lucky train, I'll call it right now, and we've seen this happen before, and it's a lot of new investors who've never seen what can actually happen. And I know this is going to happen. When it falls apart, they're not going to say, oh, I made a mistake. They're going to say, oh, stocks are risky, the game is rigged, it wasn't fair. It's like, no, you didn't know the rules of the game, and you just started playing.
Well, and the other thing that I think could create some problems is the new SEC chair. I think his name's Gensler. He's talked about, potential regulations on this. And I'm not a big regulation guy, but I understand rules that make sense. And I do think that there is a need to protect the integrity of the stock market, and this is not right. And, we're not growth investors.
Right.
But I respect that side of investing. It's a different methodology when it comes to it, but you're still valuing the fundamentals of a company. You're looking at, the potential growth is there.
Right.
With these meme stocks, there's no fundamentals from a growth perspective or a value perspective to justify the worth of a business. That's not integrity, protecting the integrity of the stock market. It's a game. It's gambling. It's a casino. That's where you start to lose and create big problems. And I understand if they come into some regulations. And the other thing, too, is you look at us as, professional money managers. We have a whole set of rules that we have to follow when it comes to discussing stocks that we own in our portfolio. These people on Reddit, are they enacting a pump and dump scheme? It's going to be very interesting to see if these people hyping up stocks on Reddit, did they end up pumping it up and then selling it? Because that's not fair. That's an illegal maneuver. Right. And that can't happen. If big money can't do that, I don't think small money should be able to do that either, because there's people probably making millions off of this. And they're like, oh, yeah, I'll go on the Reddit board. Yeah, no, we're going to take it to the hedge funds. Oh, I'm getting out of this, and I'll let the other people deal with it.
Exactly.
And I think that should be illegal. I think there needs to be some accountability for these people, because they're taking advantage of the small guy that wants to be part of this big cult and take it to the hedge funds, and they're like, oh, I'm going to take advantage of these people. That is wrong. And I think there needs to be some research into these chat forums to see if people are profiting off of the smaller guys.
Right. And I remember in the industry, when I was first in the industry, you couldn't say certain things. You said, well, what about free speech? Free speech does not apply to the investment world, because you can't go out there and, again, do the pump and dump thing. So, and Reddit, I don't think these guys are under any regulations right now, but things are changing. And I think you're right that the SEC will come up with different things that you can't say that with certain.
And maybe some of these guys that are on the forum, maybe they do, because it's different if you talk about a stock favorably,
right,
but then you don't act on it and don't sell it. But if these guys are on there, yeah, we're doing this, and then they sell it, and then it goes down, they hype it back up, and then they, sell it again. It's like, that's illegal.
Right.
But if you are on there and you're hyping it up and you hold it, I don't have a problem with that. I think it's silly, but I do have a problem if people are kind of taking advantage of these chat forums and and enacting that pump and dump scheme.
Yeah, and there was a guy this many years ago. He was from USA Today, and he was a financial writer, and he was actually doing that, and he was actually buying the stocks. He did get all of a sudden he's gone. He got in trouble for that. So I think that's what they're working on to try to get these guys, because again, I know they're benefiting from it.
Yeah.
Are they pumping and dumping? Maybe not. But you can't benefit so much. That's why generally when you go on TV, you got to say, well, if you're talking about a stock, you got to say, well, yes, I own it. No, I don't own it. Yeah. So, but yeah, things are changing. Let's move on here. I think we want to talk about value investing was the other thing we want to talk about, which was I want to tell people, remember, past performance is no guarantee of future results. The other thing that we have to tell people many times when you talk about investing, while growth names like Apple, Tesla, Amazon, and Netflix have dominated over the past decade, it doesn't mean that will continue. In fact, we believe it's time for value to shine, and this will happen.
And also to continue that shine, because value's done very well over the last few months, and I do believe that it's not like, a few month phenomenon where all of a sudden now it's time to get back into growth. Again, growth's been hot for over a decade. I think value could be hot again for the next 5-10 years as well. And it's like, oh my gosh, I didn't see that one coming. Things go in cycles, and you don't want to be on the wrong side of that cycle. And the reason we bring this up is, according to Credit Suisse strategist Jonathan Golub, historically the Russell 1000 Growth Index trades at a 5.6 times multiple point premium to value. So to make that simple, let's say value trades at 10, growth is going to trade at 15.6. That's just the history of that average discrepancy there. Well, currently it trades at 10.3 times over value. So again, make it simple here. Value trades at 10. That means growth is now at 20.3. So we have that 10.3 discrepancy. I mean, that's almost 2 times historically what it normally is. Each point of that valuation gap that narrows would mean 4% or 5% outperformance for value over growth. So that means, if we narrow that gap by about 5 times, you could see about a 20-25% differential between value.
Right.
Which could be huge. And it doesn't mean value goes up 20-25%.
Exactly.
It means
I was gonna
growth
say that,
could
yeah.
also fall,
Fall,
which
yeah.
you have to be very cautious of.
And I think it'll be a combination of the two is what I believe is you'll see growth fall, and some of that money will move to value. So it may be, growth drops 15%, value goes up 10%. That's just not exactly going to happen. We'll give you an idea of what we're talking about.
Yeah, and again, we always tell people this. Be cautious overpaying for your companies as things can turn quickly in the world of investing. I mean, I'm not going to say it can happen tomorrow, or I'm not going to say it's going to happen tomorrow, but it could happen tomorrow.
Right.
Well, actually, it can't. Tomorrow's Sunday. It could happen Monday.
Let me open the phone lines while we're still talking here so I don't forget. 866-577-2473. That's 866-577-2473. You got a stock that you want to talk about, you're looking to buy, selling, or holding, or you have general investment questions. We do that as well. Give us a call. Right now, all lines are open, 866-577-2473. And Chase, I'm going to test your memory here. I think it was months ago. We did a post about how often corrections happen. I saw somebody on Fox Business the other day. I'm pretty sure he said that they happen. We get one every year. Remember we did that post?
I want to say a 10% correction, and this is, again, going off potential knowledge that I have,
Right.
is I want to say a 10% correction happens every 14 months. So about every year.
Yeah.
It does occur. So I want to say it's 14 months. I don't know why that
Right.
number stands out in my head.
Sounds like a good number.
Yeah. So, and we did have more than a 10% correction last year, obviously,
Yeah.
but now that's coming up on more than 14 months.
14 months, yeah. And that's why we say, I mean, to be patient, and we're not telling people jump out.
Yeah.
You don't want to jump out, but you want to be cautious. Like one thing we do when we manage 401ks, we will actually do things a little bit differently. We'll take some off the table because we can't, and invest the money. So you try to back off a little bit, waiting for that time frame. But don't be 100% in or 100% out. And it's very hard because when people come over, it's like, gosh, I've been with you for 3 months now, and you've only invested 30% of the money.
Yeah, there's a big difference between what we're talking about and also timing the market. We're not timing the market. We're looking for good values, and we're not going to buy something just to buy something. But we also don't sell something just because we're nervous.
Right.
We still wait for companies to hit our valuation metrics. So it all comes down to the values. That's not timing the market. Timing the market is when, I got to sell everything because I'm really worried about stuff.
Yeah.
That's what you don't want to do. What you want to do is you want to be methodical. You want to be understanding of what you're paying for things. And when things get crazy, things get expensive, sell it and look for something else to buy. Doesn't mean you have to buy it tomorrow, but to have that full intention of buying something, you just want to make sure you're buying something that trades at good values.
Exactly. All righty. Phone number is 866-577-2473. That's 866-577-2473. Let's go out to La Jolla and speak with Vicki. Vicki, you're on the Smart Investor with Brent and Chase. How can we help you?
Hi, good morning, Brent and Chase. How are you?
Good. How you doing?
I'm very well. I'm really calling for a friend who was not comfortable phoning in, so I said I would do it for them.
Oh, well, that's nice of you.
And it's a JMSIX, which is a JP Morgan income fund, and hopefully for capital appreciation. I think they only invest in U.S. securities, but I'm not sure. And I guess my question is this a good investment for inflation hedge?
I know Chase is going to be looking this up a little bit more because when I pulled it up on Reuters, it doesn't come up. So Chase might be looking at Yahoo Finance because you want to look at the fund. And this is what we do when we actually analyze funds for people in 401ks is look what the holdings are.
Yes.
Because income fund generally means they pay dividends. They could have some bonds in there, which would be terrible as rates rise. So Chase, just signal when you got it. You got it up?
Computer's moving a little slow today.
Our computer's slow today.
But it was JIMSX.
No, JM.
No. JMSIX.
Yeah. John, Mary, Sherry, Ida, X-ray. Yeah. So
There it is.
You got it? Okay. So, yeah, what's so important, Vicky, is you look at what the fund has. You also want to look at the turnover ratio, if we can find that quickly. We don't get many calls on mutual funds on the radio show, so we're not really prepared for them. But I think we'll pull some things up here because these are things you want to look at, what the holdings are and the sectors and stuff. So what do you got there, Chase?
I'll kind of start off the expense ratio. Obviously, that's important to look at. A lot of times people, and I'm going to talk about when they hire financial advisors, it's an important thing to look at. If your advisor is putting in mutual funds, I just pay my advisor 1%. Well, if they're putting you in mutual funds that also charge 1%, where your fees are quite high. But if you're doing this yourself, it's important as well to look at the expense ratio for the JP Morgan Income Fund Class I. It is a expense ratio of 0.42, so that's not bad. But I say it's not bad because it's a multi-sector bond fund is actually what it is. It doesn't look like it holds equities. I mean, the yield on it, those 4.39%, so that does worry me a little bit as it's likely investing in some higher risk items.
Yeah, multi-sector means they probably do good bonds, high yield bonds, international bonds. So they're really mixed that way, and I'm not feeling comfortable with it. And then I don't know if you can see the percentage of what they have in each sector.
I'm looking at what they hold here. Just kind of looking at some of the ratings as well. Important to look at that. They do have about 19% of it in AAA rated, but then you start to get down in triple B, it's 16%. In double B, which is actually considered junk, it's 27%. In single B, it's 11%. Below B, 18.7%.
So this is really on the high risk side because that's about 50% is in junk is what it looks like.
99.5% of their bonds, energy.
Oh, wait, 99.5% is in energy bonds?
That's what it says.
Wow. See, and this is why it's so important to really look at where you're invested because, and again, we like energy. Energy we think is doing well and so forth. But to have that much, and also you're on the high risk side of the energy side, there will be some energy companies that could go bankrupt, and this one could be hurt.
And I will say, this is just off Yahoo Finance, so it's not 100% foolproof. It's not their perspective. That doesn't add up because it shows that Federal National Mortgage is 1.5% of the fund, so that's already more than 99%. So definitely something to be cautious of in terms of how much is truly in energy, but that's not adding up. So I do want to point that out. And also, too, I see Dish DBS Corporation that has like a 5.88% yield that I know is more of a communication, not energy, but that's 0.4% of it. So it looks like it's just thrown a bunch of things against the wall there with high yield, and hopefully not everything goes bankrupt is the plan of this fund. But the thing is, some of the things, let's say if 3/4 of them go bankrupt or 1/4 of them goes bankrupt to be on the conservative side, well, now you lose that principal in those funds, and hopefully the other ones can pay enough yield to offset that is what these kind of strive for, but I don't like to play that game.
And Vicky, the person that you're calling in for, do they have a lot of money in this fund or just like a small amount?
None, I don't think. Just looking at it.
Oh, just looking at it. Okay, were they advised to go into this? Or?
I'm sorry?
Were he or she advised to go into it, or?
From a phone call, to a company, they were advised that this was a good one. But I also said, I wonder what they're investing in. That's what I want to know. And if it's a lot of bonds and that much in energy, I don't think so.
Yeah. I think it's a combination of it is in bonds, which we don't like. You do have a lot on the high yield side, which are junk. We've determined that's not all energy, but I'm sure there's a big amount in energy. It just, and I think what people do, they look at the yield. What was the yield, Chase?
4.39%.
Yeah, and that's what somebody looking at. Oh, I get a 4.4% yield on this. This is great. It's like, no.
And I just got to point out, I mean, if you're getting 1.5% on a 10-year note, I mean, that means you're taking on a substantial amount of risk to get 4.4% in bonds.
Right.
I mean, I would much rather buy. I mean, we were looking right now at a real estate investment trust for our portfolio that pays over a 5% yield. I'd rather be in that. You're going to have more volatility in that, but I think that yield is a lot safer than this type of investment. If you I want to be in bonds to diversify. I don't follow that methodology right now. I think it's crazy, and I think this is could be very, very risky, especially if energy prices are doing well right now.
Mm-hmm.
But as we've seen, they can move quite quickly if they go to the downside. It could be very problematic for this fund.
Yeah. So I'm going to say, just based on our limited research here, that I would not recommend this fund. I would have to say go somewhere else, because this fund is not worthwhile. I think they'd be very disappointed down the road 12, 24 months. Alrighty?
Well, thank you, and I know my friend is listening, so I hope they heard this.
I hope so too.
Thanks again, guys.
Okay, Vicki, thanks for calling. Have a good one.
And you too.
Bye-bye. Alrighty, that does open the phone line, 866-577-2473. That's 866-577-2473. Let's go to San Diego and speak with Bob. Bob, you're in the Smart Investor with Brent Chase. How can we help you?
Yeah, hi. I just wanted to know a comparison between FRX, Beachbody Fitness, and Peloton. Is what you think as far as the two in comparison as far as sales, with the British bike and the food, some kind of a food nutrition line, along with the sports figures like Shaq and LeBron James, that'll be pushing it once it becomes a stock called body.
And Bob, what is this company? Name of the company?
It's basically a what do you call it? A SPAC.
Oh, this is a SPAC. Okay, yeah. Because when I put in FRX, nothing came up for the symbol.
Is it Forest Road Acquisition Corporation, and they're merging with something? Is that?
Yes, correct.
Okay.
They've just started the voting, I believe, process this month, and I'm sure it'll pass the merge between the three companies and the Disney guy who's running it. Ex-Disney guy.
Yeah, and I got the circle of death going here now, so I don't know if I'm getting anything or not. But
we're not going to get anything because it is a SPAC. So, I mean, we can kind of talk about it. I don't know much about the company they're merging with, but you kind of name drop some big names there.
Yep.
And one thing that we have talked about in the past year, Bob, is it is very exciting, and Shaq's behind it, and there's other people, and obviously Shaq. I like Shaq. I think he's an interesting guy.
Yeah, LeBron James, which
he's famous.
He's a big name, famous.
Yeah. So, I mean, there could be a lot of hype and momentum behind this when it merges, but I mean, we don't like to play that game of guessing what's going to happen, and I don't know enough about the business they're merging with to really give you an idea of sales. We'd have to wait until after we get some time in this business to look at it. But like Peloton, it was expensive. It is still expensive. It might trade at similar valuations, but it's really just a gamble at this point, is what you're looking at.
And Bob, this whole thing is very complex, and it's kind of like based on I'll say the hype and so forth, and it could do well, but a lot of SPACs that they're not so hot any longer. They've kind of realized that a lot of them have kind of fallen apart, and they weren't really built on a lot. So I mean that's why when you called in, we kind of look for the symbol, like, well, what is this company about, and so forth, to try to give you some numbers. There's no numbers on it. I mean, it's a very highly speculative thing that could do extremely well. But on the SPACs, I remember reading the Wall Street Journal months ago, they said, a lot of these names, these athletes are getting in there. They're getting paid to promote this stuff. They know nothing about it. But just because of name recognition, they're doing it, and people are buying into it because of the names. And we don't invest that way. When we invest, we want to get a company that has profits and good sales and not a lot of debt and cash flow, all these other things.
Oh, they won't have any debt. It's Beachbody Fitness. They've been around for a long time, and they've always continued during the epidemic, since they're pretty much outdoors on their fitness programs.
And I may not, because again, as you were talking, I was trying to look for some information on it. But why is that company not just going public themselves?
I have no idea. I believe it's just because this guy, the ex-Disney CEO or whatever, has basically been successful at merging other companies together to make them more profitable and more, open to the people.
I just kind of feel when they're doing something like that, they're trying to hide things. And I think there was also, too, behind the scenes on the SPACs, I think the creators were getting, 10%, 20%. I mean, I don't think this is good for private investors, because it's just like, I think others are going to make money, not the investors.
The other thing that scares me a little bit too, Bob, is on the SPACs, there's a whole different set of rules. Is when you go public through an IPO, there's different kind of estimates that you can talk about with the company. But when you go via a SPAC, you can kind of say what you want. Like I know Fisker, when they went through their SPAC, they're like, yeah, we're going to do sales of this, and you can kind of build on that hype, build on the momentum. And I mean, it's a different type of investing. As I said, it's truly a gamble here. And we miss IPOs. We miss the mergers with the SPACs. It's just not what we do. I like to see good information, good sales, and sometimes we'll wait a year to make sure we're investing in something safe. We know that we have data, and maybe this company next year all of a sudden, hey, we've had good data now for a year. Maybe at that time we'll look at it and say, yeah, it's a good time to buy. But we don't like to take that chance. We want good data before we invest in something.
Yeah. All right, Bob.
All right. Thank you.
All right, thanks for calling. Have a good one.
You too.
Bye-bye. And that does open the phone line, 866-577-2473. That's 866-577-2473. All lines are open. Jace?
Yeah, I was going to say, it is interesting. I mean, the whole fitness industry has kind of gone through changes. I did pull up their website and stuff. Beachbody.com is it's the world's greatest gym right in your home. So I think that's what Bob was asking about in terms of comparing it to Peloton. I just feel like there's a lot of competition there with I remember my mom used to do like the Tai Bo videos in the morning,
right.
you know.
Years
And
ago.
it's like it's been around for years, but now it's different now and it's changed. But it's really been around, and it was interesting. I was reading an article on Planet Fitness, and the CEO was saying, he's like, people have been doing at-home workouts for decades. It's not like this is something that's completely new.
Right.
You know, there's the at-home videos, and then, I have a stationary bike. And he's like, I mean, Peloton, it's new, but it's not a completely new competitor in the essence that people have worked out from home for many years. So I think that this has been around for a while, and it might be trading on the hype for a little bit, but I don't like to trade on hype because you don't know when the hype ends.
Right. And well before your time, there was a guy named Jack LaLanne, who actually, that's what he did. He was on TV, and it was in black and white because back in the 60s, and he had people working out from home. He did open up his own fitness centers and became very, very wealthy. But again, that was back in the 60s, that working out from home.
What about, what's that like? I know there's the Kiss guy. Is it Gene Simmons? There was Gene Simmons or something that did like the jazzercise.
Jazzercise,
you know?
yeah. Well, last name was Simmons, and I don't know if it was Gene Simmons or not, but I know who you're talking about, yeah. And he was like, come on, ladies, let's get going. He's always trying to motivate. He's this funny little guy that, everybody loved him. But that's true. It has been going on for a long time. And I don't know. I mean, I drive by 24-hour fitness this morning. I noticed that the parking lot, they used to have this outside gym. That's gone. Yeah. So I think we are moving back to being more in the gym. I know here in California, Tuesday is going to be the reopening. So we could see things change here and see that more people are going to go back to the gym. Because I like working out from home because I get to watch the business news while I'm working out. But I do remember going to the gym, and I'll probably go back to the gym a little bit. You're just more motivated.
Yeah, I mean, I had this really good setup at my house years ago. Right. I mean, I had a squat rack, I had dumbbell, I had all this stuff, and I was like, I'm done. Yeah, right. you have that option basically to end the workout where it's like, I already drove here, so it's like I'm gonna be here for an hour. You kind of have that motivation. I personally, I just can't work out at home. It's very hard for me to get in that mindset. And I think a lot of people are that same way as well. So I do think that, this whole at-home craze when it comes to doing everything from home, I think it was completely overblown. I don't think it is going to last in the same magnitude. And there will be
It'll never go away.
Yeah, there'll be some changes, but it's like anything in life. Things always evolve. Things always change. But it's not going to be, as people would say, the new normal last year. Right. I hated that.
And I think Peloton did so well because they really had no competition. Well, now when gyms reopen and people are like, well, and I can see this happening, that $2,500 machine sitting in the corner because you kind of lost interest because it's still on the video. And, I know people really love them, but it's still not live. And I think we will
Well,
see.
you're live with other people, I guess, but it's still not like in-person live, I guess is what you're saying.
It's like Zoom.
Yeah.
I mean, we still like to meet people in person. We'll do a Zoom if somebody's like in Texas or someplace else, but it's just not as good as meeting somebody in person. And so,
Yeah, I just think it's going to be it'll be interesting to see how things change over the next, let's say, 5 years.
Oh, I think it's pretty less than that.
I'm just saying probably next year there'll be some change, but I think in 5 years it's going to be completely different than it is obviously today.
Based on my history and experience, I think by next year it's going to be totally different.
Yeah.
So things will change. We'll see.
I don't know about you guys, but when I look at the person next to me on the treadmill, I want to go like 0.1 faster than them. Or
There you go.
I don't get that feeling anymore.
That competitive. You're right. That competitive things, and you do see other people working out. Like, well, they're working. I remember that. Sometimes I'm sitting there like, well, they're working. I better get busy. Yeah. It is true. So.
Oh, you did 155? Well, I'll do 175.
That's right. That's right. That's how I pull my shoulder. No. All right. Phone number is 866-577-2473. That's 866-577-2473. I do see Jairus there. Before we go to Jairus, I do want to talk to our financial planner, Harrison, from Wills Asset Management. Harrison, good morning. How are you doing this morning?
Good morning, guys. Doing well.
Good. I know today you're talking about emergency funds, correct?
Yep. Jenna, talk about emergency funds. I know you brought this up as a topic last week, so I want to talk about it this week.
Good. Okay. Well, because it's so important for people to have the emergency funds, but many times they have too much or not enough.
Yeah, and that's really the thing. So, and this is not talking about cash that's set aside for travel or buying a house or purchasing a car or remodel or anything like this. This is just the emergency type fund. So, last year when COVID started, a lot of people lost their jobs, and once they didn't get that first paycheck, a lot of people were struggling. And, that's where one of the areas where emergency fund comes in. So we hear the rule of thumb, you want to have 3 to 6 months worth of expenses. I'm generally not a fan of rules of thumb because I don't think they're specific enough for individuals. In some cases, 3 to 6 months is fine. Some people need less, some people need more, but I would rather have the right amount for every person so their financial life is as efficient as possible. So some of the things you want to look at is how secure is your income? If you're someone who's receiving Social Security and pensions, and that's covering everything you need, that is guaranteed income. You can't be laid off from it. That's a whole lot different from a one-income household that's income is 100% commissions coming from sales or something like that. So, completely different situation. So depending on how your income is set up, that can help determine how much money you need to set aside. Another thing is how much of your income every month do you spend? If you're someone who has to spend your full paycheck, that means you're probably going to need a little bit more cash. Whereas if you only spend half of your paycheck every single month, if something comes up unexpected, you'll have more cash flow at the end of every month to make that, so you don't need to withdraw from cash. Another thing is how complicated is your life. If you have multiple properties, multiple cars, multiple kids, higher fixed costs every month, you're going to need to have more cash than, a single person who doesn't have that much. So again, your lifestyle really tells you how much you need to have. Another factor is how liquid are your assets. If all of your assets are in real estate and IRAs, that you can't really withdraw from without having really large tax consequences, that's a challenge. Then you're going to need to have another plan in order to access funds if you were to need it. So one thing I want to point out is, emergency funds are important, but that doesn't mean you need to hoard a bunch of purely cash just in a savings account somewhere. Right now, interest rates are really low, so cash is not earning anything, so we don't want to hold any more cash than necessary. We would rather have that money set aside to be used for something that can make us money. So some different options would be to look at a HELOC. Right now, a home equity line of credit, if you use your house as collateral, you can get a rate anywhere from 2 to 6%, depending on your credit worthiness and what you can qualify for. But if you have a HELOC against your house, that's money that you can access if you need it. It doesn't cost very much, and then if you don't need it, you don't have to pay for it. So it's kind of a nice little extra contingency plan. Another one is a securities-backed line of credit. So it's like a HELOC, but instead of using your house as collateral, you use a brokerage account. And so interest rates on those are anywhere from 1.5% to 4%, depending on how much you have in that brokerage account. So again, another area where you can access funds if you need to, while you can keep your money invested in and growing for you. So, depending on your situation, there's people out there that actually need little to no emergency fund, depending on their situation. And then there's people out there that probably need over a year's worth of expenses because their life is, structured a little bit differently. So, I would say don't settle for the 3 to 6 month rule of thumb, because you're either, number one, going to be missing out on growth by having too much in cash, or you're going to be exposing yourself to too much risk and not having enough money in cash.
And Harrison, it's so important that you bring this up, because you can tell it's a well thought out process when people come into you as a financial planner, that you ask these questions, because many times they go to a financial planner and they go by that rule of thumb. Also, too, some people say, well, I'll just do it online. They have a financial planning thing online I can use, and they use those rule of thumbs. So you've got to have these live interactions to talk about these many different aspects you brought up, and I'm sure there's more than what you brought up. But this is why a good financial planner is so important, to look at these things, because everybody's situation is different.
And I just wanted to circle back one more time, too, on the credit line ideas there, Harrison, is I just, when you talk, I don't want to go into debt. I don't want to go into debt. The thing that people have to realize is if you open up the credit line, you don't start being charged an interest rate until you actually take money out. So it's like a, revolving credit type deal. It's not like, oh, it's a fixed loan amount. It's you only start incurring interest once you have it. And the thing that you always say is, it's easy to get a loan when everybody wants,
It's easy to get a loan when you don't need the money.
Yeah.
When you need the money, no one wants to give it to you. So that's why you do it when you don't need it.
Yeah.
And I had a credit line back when I owned a house a year ago now. And I think I paid $50 a year to keep that open. And what a great thing it was, because, again, you could use if you need it. I never needed it, but if you do. And, again, it's not right for everybody, but, again, it's a great idea to look at it. And this is why you have a financial planner like yourself, Harrison, for people to explain to you that, yes, this fits your situation, but it may not fit your neighbor's situation.
Yeah.
So, well, Harrison.
The whole idea is to add value to someone's situation, because, you can sit on, a few $100,000 of cash, and if something comes up, you'll be able to handle it, but you've also missed out on what that money could be doing for you. So we want to do the right thing for every individual, and that improves their life, and that's really the purpose for it.
That's right. And I think you had, and I was going to close here, but I thought you had one other comment you had from last week or something. Was that correct or no?
No, I'll talk about that another time.
Another time. Okay.
Well, we can kind of tease with it, I guess, is, I think next week you're going to talk about, because last week you talked about expenses in retirement. Now you're going to focus more on the medical expenses in retirement, correct?
Yeah, because it's a totally different thing, kind of separated from the inflation aspect of it. Inflation is a part of people's retirement, but the medical expense stuff and healthcare stuff later in retirement is totally separate. You need a totally different plan for that. So I'll talk about that in one of the coming weeks.
Well, that's a good tease. Probably next week, right?
Probably next week.
I guess I kind of forced you into that, didn't I? Well, Harrison, thank you very much. You have a great weekend, and we'll see you Monday morning.
Sounds good, guys. See you Monday.
All right. Bye-bye. Harrison Johnson, he is our CFP, our financial planner at Wilson Asset Management. There is a free consultation with him. And again, if you went to your financial planner and they did that rule of thumb thing on your emergency funds, you need to fire that person and say, wait a minute, I need to go talk to Harrison Johnson, because I need somebody that really talks and understands my situation, digs deep into it. And I know many times when Harrison does the first real appointment with people, he's in there for a couple hours.
Yeah.
I mean, it's kind of amazing. So, but he's finding all this information about you. So you want to talk to Harrison, it is a free first appointment. Give him a call at the office, 858-546-4306. That's 858-546-4306. Or you can find him on our website as well, and that's smartinvesting2000.com, smartinvesting2000.com. And before we go back to the calls, I do want to talk about the workshop coming up in less than 2 weeks. It's going to be at AleSmith Brewery, June 24th, 6 o'clock, and that's right off of Miramar Road. At the workshop, we're going to show you how we successfully manage money for over 40 years and how I manage my own money. So I do the same thing for my clients that I do for my own personal portfolio, and that's how I've done very well. And we're going to show you that. We'll go over all the financial fundamentals that put your mind at ease when investing and keep you on the right course for long-term investing. We'll show you how we use our target buy price, our target sell price, things that maybe you shouldn't be doing in investing, things that maybe have failed for you, could fail for you, why you shouldn't be doing those. We'll talk about that as well. The workshop is free. As I said, right now it's probably about halfway filled, so we do have some seats remaining, but you got to register. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. You can call the office, speak with Brianna, 858-546-4306. That's 858-546-4306. And we'll look forward to seeing you at AleSmith Brewery, June 24th, 6 o'clock, right off Memorial Road at the Smart Investing Workshop. All right, let's go back to the calls. Let's go right back out to San Diego and speak with Jairus. Jairus, you're on the Smart Investor with Brent Chase. How can we help you?
Good morning, guys. Miss you guys, but I've been listening every weekend. I appreciate all your help.
Well, we're glad that you're there.
Yeah, quick question for Harrison. Does the Gavin Newsom vaccine lottery emergency fund, does that count?
You know what? He'll be here next week. You'll have to ask him. I'm not going to touch that one.
All right. It's kind of like no eating in the car type of thing, right?
Oh, you're listening close, aren't you?
I take notes. I listen carefully. Real quick, it's not the Gene Simmons exercise program. It's the Richard Simmons.
Richard Simmons.
I was like, Gene Simmons, I know that's the guy from Kiss, and I was like, I just know it was like Simmons, and I couldn't think of the first name. So thank you, Jairus.
Yes.
Yeah, those guys only exercise when they're playing their concerts. They definitely get a workout though.
Yeah, and you're talking about Gene Simmons.
Yeah. That's the guy with the big long tongue. I don't know if you guys know that part, but maybe that's too much information.
Yeah, that's TMI, and I didn't know that part. But how can we help you on the investment side here, Jairus?
Yeah, let's get back to reality. AstraZeneca, AZN. I got in at about 44, and just wondering what you guys' numbers look like, and see what you think.
All right, let's take a look here. What I'm coming up with here, and let's see here. What's going on my program here? Because I put it in and it didn't happen. AZN is a symbol for AstraZeneca. I'm guessing that they probably do have an ADR.
Yeah, they have an ADR.
Yeah. Okay. Let's see. Here we go. We got the loading signal here, and
I'm curious as well. I know that they have the COVID vaccine that did have some problems.
Right.
I'm not sure what they do outside of that. Do you know anything else about their pipeline there?
I don't. I know they're dabbling in other stuff, and they've had some problems, I believe, in India, a little bit in Europe, but I think those things are getting ironed out. So other than that, I don't know more.
All right, well, let's take a look at AstraZeneca PLC, which means in United Kingdom, symbols AZN. I do not have the normal comparison of the industry, but I do have the numbers on AstraZeneca right here. PE ratio, not a great number, 39.1. We do see price to sales, 5.6. Unfortunately, price to tangible book value, many times that's the norm for these drug companies because they do acquire other drug companies, which puts a lot of goodwill on their balance sheet, which is not a tangible asset. And then we do see price to cash flow, 22.4, looks okay. You do get a 2.6% dividend. They use 90% of the earnings to pay it out. That's a little bit on the high side. And their earnings, I don't think their earnings were low last year, but so I'd be a little bit worried about that 90% payout on the dividend. We do see sales year over year. They were up 9.3%. That is good. Earnings did climb by 160%. We're looking at the balance sheet. Got a current ratio of 0.9. That's okay. Debt to equity 140. A little bit nervous on that number. It's a little bit higher than I'd like to go. I like to be more like a high side, 125, 130. But again, you kind of look at the cash flow, look at the debt. Maybe some debt's coming due, and they'll be off the balance sheet this year. But you want to look at that balance sheet on that debt side. We do see return on equity very good, 31.6. Net profit margin also very good, 14.3. They make 14 cents on every dollar they bring in. That's very good. Receivable turnover, 4.9, and inventory turnover, 1.6. Jace, what do you got for the earnings going forward?
Well, I did kind of look at it briefly just to see what else they do, and it looks like they have different areas of oncology, cardiovascular, renal, metabolism, respiratory, infection, neuroscience. So they have different fields, and one thing that I want to make sure you understand here, Jairus, is what else is in their pipeline. So, for example, Pfizer, they benefited, of course, by the COVID vaccine that they had, but it wasn't a huge part of their business. It was like kind of icing on the cake. I think it's kind of similar here with AstraZeneca, but I want to understand what else is in the pipeline because we know the COVID vaccine, shouldn't be a huge moneymaker for the next 10 years, let's say. So I want to make sure that they have something to kind of bolster them as we do move on from the COVID vaccine. But kind of talking about the numbers here for AstraZeneca, I do see current price $58.77, 52-week high, well, that's $64.94, and the 52-week low is $46.48. If I go out to December 2022, I see estimated earnings per share of $3.72. That would give us a target sell price of $61.75. So right around that kind of sale price there. I'd keep a close eye on it. I don't know if I'd sell it now, depending on their pipeline, but it's definitely getting close.
And I did take a quick look at the balance sheet for you here as well, and I saw that their debt has climbed by almost $2 billion from $18.5 billion to $20.1 billion this year. So their debt is increasing, and I'm not sure why that is. I see a big spike 2 quarters ago. It was up to $22 billion. But I want to understand what they're doing with their debt here. Maybe it was for some drugs, but, I mean, it just worries me being that high a debt because you could have problems if their drugs don't do well. You could see the stock start to fall. So I would normally, when we're looking at it, we look at actually years past. We'd also look at the cash flow as well. So kind of give you some direction there to look at. I think you said you hold this, correct?
Yes, I got in at about 44 or so.
Okay, yeah. I mean, I think it's okay, but I would just kind of watch that balance sheet and the cash flow, what they're doing. Already? And I think, Chase, you said it's close to the target sell price. Yeah.
Yes.
Yeah. So, all right.
Thank you so much, gentlemen. Look forward to meeting you someday.
Yes, and we look forward to that. You have to come to the workshop someday.
Yes, I've got it on my calendar right now. I just need to check with my wife and see if we can make it work. I'd love for her to come out and have you guys explain things. She's a lot more conservative than I am, and I'm pretty conservative myself in the investing part. So June 24th, 6 o'clock.
All right. Well, we hope to see you there.
All right. Take care. Bye.
Okay, Jarvis. Bye-bye. All right. That does open the phone line, 866-577-2473.
I know I'm pushing against a break here, but I did want to bring up kind of how Jairus said his wife's a lot more conservative when it comes to the investing. It's so hard because sometimes you're too risky because you're in stocks. Other people say, you're too conservative because you don't buy Tesla. But, that's why we don't look at, we're trying to appease risk tolerances. We're just trying to buy good businesses. And, I don't look at being conservative, being aggressive as I want to buy good companies. So, I think we have a good balance for people that are worried about things, so we don't buy the crazy things.
Right. And again, we'll talk about this at the workshop, the difference between risk and volatility. I mean, risk is where you have the potential of losing all the money. Volatility is the up and down movement, and people don't realize that. And so it's the education, and we fear the unknown. And that's why people say I'm conservative because I'm fearful. Well, it's because you don't understand how business works. You don't understand what you're kind of looking at. If you should invest, if you're going to do it for a month, that's gambling. But if you have money that you're looking at 2, 3, 4, 5 years down the road, you should be buying good quality businesses at good prices. And that's why right now we're very patient. And we haven't bought anything lately, but we're looking at, and I think about something a couple months ago, but we made, I think, more sales so far than buys. So, all right, we're going to take a quick break here. I do see Wayne wants to talk about, it looks like Ford. They've got Mike from Normal Heights, then Phil in San Marcos. Phone lines are open on top of that, 866-577-2473. You are listening to Smart Investing Show. Brent and Chase, stay with us. We'll be right back. All righty, welcome back. The second hour of the Smart Investing Show. We got phone lines open, 866-577-2473. That's 866-577-2473. Chase, you see a trash can over there by you?
It's behind you.
Behind me? Okay, I want to throw out this Reese's Crispy Crunch bar. It is the worst bar I've ever had.
I thought you said it was good.
No, I didn't say it was good.
I thought at the beginning.
No. I took a bite because I was really hungry. But it tastes like cardboard inside.
You hear that, Hershey stocks? You're going downhill now.
Yeah, we don't own Hershey's, so it's okay. Now, if I owned Hershey's, I wouldn't buy the bar. All righty. Let's talk about the workshop because it is coming up. And we want to make sure that people hear about it. We said Jairus is going to be there. Seating is limited there. It is going to be Thursday, June 24th at 6 o'clock at AleSmith Brewery. And I know a lot of people really liked it there last time. Yeah. They liked the beers and stuff, had a good time and great information. The workshop, we're going to show you how we invested money successfully for 40 years, all the things I've built over these years. And I will tell you, in the beginning, I made some mistakes. Well, we're going to show you the mistakes that investors make, and I've learned from those mistakes and why we do things the way we do. Also, we are going to show you, how we get our target buy prices, how we get our target sell prices. We're going to go over the financials for you. Why investing the right way is not risky if you understand what you're doing. That's what we try to do. Try to educate you on investing so you can do better. I know, unfortunately, some people, they're so afraid of investing, they keep it in the bank and they earn 0.1%. It's such a shame because when you invest longer term, you should be averaging 8, 10, maybe 12% on average per year when it's done right. So that's what I'm going to show you there. So it is free. Seating is limited. You can sign up at our website. That's very important because if you're not signed up, we won't know you're coming. Website, smartinvesting2000.com, smartinvesting2000.com. Just look for the workshop page there. It's just right on top, I think, on the right-hand side. You click on that. You can also call the office at 858-546-4306. That's 858-546-4306. Speak with Brianna. She just signed up. And we look forward to seeing you at the workshop on June 24th, 6 o'clock at AleSmith Brewery. All right, let's head right back to the phones because I know we got quite a few callers here that are kind of been waiting. Let's go to San Diego and speak with Wayne. Wayne, you're in the Smart Investor with Brent Chase. How can we help you?
Morning, gentlemen. Just like your opinion of Ford Motor Company.
Okay. And do you hold that or looking to buy it?
Looking to buy it. They've got 2 new EV trucks coming out. So that may be something interesting.
Yeah, they've really kind of turned things around. I know about a year or two ago, they were way behind in the EV market. They've seemed to come on pretty strong.
Yeah, and one thing I think I talked about last week or the week before was, the Ford Mustang Mach-E. That's one thing you got to be open to changing your opinion. Because at first I hated that car. I thought it was ugly. Now I saw it on the road. I was like, wow, I think it looks pretty nice. Yeah. You got to have an open mind. Be flexible with your opinions there. And I think they did turn the corner, and I know that's actually been doing pretty well for them in sales. I will say I still do not like that they call it a Mustang, and it's not a Mustang.
Not a Mustang, I know.
They should have just called it the Ford Mach-E and just left it at that. But I digress from there. And the Ford F-150, I think Lightning, obviously Ford's been kind of well known for their F-150. If they can kind of commercialize that electric version of it, I think they'll do quite well.
Yeah, I'm very curious, and I know General Motors, they have electric trucks as well. I'm very curious how that's going to work in the construction industry.
Yeah.
Because
you need towing power, that's for sure.
Yeah, the towing power, the torque. And I continue to kind of look at the Tesla Cybertruck, and I know that they've had orders, but I just feel like it's a different crowd. I don't think you're going to see the Cybertruck on construction sites. I just don't see that occurring.
And I don't see many women drive that because it's huge.
You
have to buy a dump truck.
and actually, they may create a whole new market for that truck. But again, for the construction side, again, you want that pulling. You want that. A lot of times, like with electric vehicles, when you use a lot more power, you try to go fast or pull more, you take up more energy. So that's why I'm wondering how they're going to work on construction side. Because if you're pulling some big trailer or whatever for whatever reason, you may use up all your energy and not be able to get home from the job because you're pulling that. So we will see how that develops. But let's take a look at the numbers on Ford. I'm glad you called about this, Wayne, because I was kind of curious with all this new EV stuff, how they're doing. Company, the symbol for Ford is F. We do see the PE ratio, great start here, 15.5 versus 73. Price to sales, 0.5 versus 2.9. That's very good. Price to book value, 1.8 versus 7.5. And then price of cash flow, also very good, 4.8 versus 15.74. They do not pay a dividend. I do see year-over-year sales are down 13.9%. The industry was down 6.3%. I'm kind of curious why they were down by so much. I thought they were doing better than that. However, earnings look very good for Ford. They were up 230% year-over-year for the last 12 months, but the industry shows a gain of 2,914. Looking at the balance sheet for Ford, we got a current ratio of 1.2. That's about the same as the industry at 1.28. Debt to equity 451 versus 156. And here with these these auto companies, you want to check to see what the amount is that they're actually using to loan out for the cars, because they're like a finance company. So you got to kind of pull out what the total debt is just for the company. You generally find that in the 10Q, the 10K. We do see return on equity is 12.5 versus 11.1. Net profit margin 3.1 versus 4. And then we do see receivable turnover is 15.1 versus 3.3, and inventory turnover checks in at 9.9 versus 8.9. Chase, what about the numbers going forward?
Yeah, so current price here for Ford is $15.28. 52-week high was $16.46, and 52-week low is $5.74. I go out to December 2022. I see estimated earnings per share of $1.73. It would give us a target sell price of $28.72. So the valuation still look very good on Ford. But a couple of things I want to understand more about this business is, are they looking at other opportunities for kind of more reoccurring revenue? I look at Tesla, I look at GM. They kind of have plans in the future to kind of almost create subscription type revenue where you're getting that on a reoccurring basis. Does Ford kind of have any plans in their marketing strategy, their business plan, to actually have reoccurring revenue? Because that could justify higher multiples. If not, I think that they'll continue to lag GM, and they'll continue to lag even Tesla with that.
And one thing, too, I'm wondering about as well, because I know big with GM and Tesla is autonomous driving. Yeah. I've not heard those words come out from Ford yet. I could have missed them, but I've not heard anything about that.
They're out there, but I do believe their technology is still behind both of those companies. So I would be curious as to what their plan is on the AV side as well.
Yeah. Yeah, and again, I think Ford's done a great job catching up here, because they were way behind before. Yeah. So they've done a great job on that. The thing is, can they sustain it going forward is the big question.
And I also remember last year looking at kind of some of the warranty costs that they had. They were just having big issues in terms of, I'm going to say, their operations. They had some costly repairs that they had to do to vehicles, and it was just way beyond what other automakers were doing. So have they kind of resolved those areas of concern as well? Because that's going to continue to ding profit margins if they can't get that resolved. So I know last year we talked about it as an opportunity if they can resolve some items. I am curious if they've kind of been on that path towards resolution and getting things fixed.
Yeah, and I mean, Chase, you gave the numbers there on the target sell price and so forth. It may be worth waiting for maybe a pullback on it, because I think there's been a lot of push forward to get to $16 a share. I think it was $15.28. So maybe on a pullback would make some sense, but I just think they could have a difficult time. You bring up the warranty cost, the autonomous driving. There could be some problems, some headwinds for Ford going forward. All right, Wayne.
There's still a semiconductor shortage. Chip shortage.
True. That's right.
That's another good point. Is I'm curious how they're kind of combating that. I know a lot of these automakers have changed some items. Like I know GM did drop the stop and start function on their engine, which I think it hurts gas mileage by a very small amount, but they're still able to get the cars out there. I'm curious how Ford's kind of dealing with it to continue to drive sales and get cars onto the lots, because we know that there are a lot less vehicles on lots. I was driving down Poway Road yesterday on my way to the high school, and I looked at the Nissan dealership, and I remember they always had just cars in that spare parking lot. I think there was like 3 cars in the spare parking lot.
And they're not closing. They just don't have cars.
Yeah, there's no
inventory.
cars.
Wow.
No inventory.
Wow, you should have stopped in.
That's because of the semiconductor chip shortage.
Yeah.
The car dealers in San Diego are going to the used car auctions to buy cars to put on their lot to have something to sell.
There's even a shortage of used cars as well, because their prices are going up.
Prices are gone crazy.
Yeah. So it's again, great time to sell a car, not a good time to buy one.
Like the house.
Wayne, thank you for calling.
Have a good day.
All right, bye-bye.
I was like, gosh, I almost think maybe I should just sell my truck right now and just Uber for a little bit, because my truck, and I don't think I've ever seen this, is worth more than when I bought it.
Yeah,
and it's like up pretty substantially. It's not like it's a small chunk of change. I'm up a decent amount on my truck. I'm like, should I just sell this and take a lift for a little bit, or maybe get a Vespa or a moped?
Yeah, maybe the moped. I can see on a map, but no, you can do because you're so active. I mean, going to work, you go to the gym. Now it sounds like coaching for Power High starting up again for you. So I mean, it's just like if you had more of a less scheduled stuff, but maybe sell the truck and buy like a. And we used to do this back in New York when I grew up in New York. You would have a beater that you drive during the winter. Yeah. It was usually not a very good car, but you didn't care because you might slide into snow banks and mess it up. So maybe you get a beater that costs you a few grand, and so it depends on how much. But then you're not.
I like my truck a lot too.
Right,
so
right. well, maybe your fiance drives something nice, and you drive the junk for a while.
Yeah,
I don't know.
We'll see.
Is it worth it, though, for a few thousand?
Yeah, exactly.
All right. Phone number is 866-577-2473. That's 866-577-2473. Let's go out to Normal Heights and speak with Mike. Mike, you're in the Smart Investment Brand Chase. How can we help you?
Good morning. A preliminary question. Is Citibank and Citicorp one and the same entity? Do you know?
I looked at this before, and there is some confusion. I think Citibank and Citicorp is the same, but there is something else different. I can't remember, and I know exactly what you're talking about, Mike, because I remember seeing that, and I was surprised because there is a different city on something else, another company. But I think the bank and the corp is the same, but there's a different city.
Yeah, because if I just Google Citicorp, I get Citigroup. So I'm not sure. I mean, there might be a Citicorp out there, but I'm not seeing it.
Yeah, and I think there's a Citigroup, a Citicorp, and a Citibank, and one of those are not related, and I forget which one it is.
Well, Citigroup owns Citibank.
Citigroup owns Citibank, so maybe there's a Citicorp out there. Yeah. So I
that helped.
Yeah.
Well,
you got some, Chase?
Oh gosh, I just had it there. Yeah, it says the company. So I'm just looking at the history of Citigroup. It says a company was formed by the merger of banking giant Citicorp and financial conglomerate Travelers Group in 1998. So now it's Citigroup because Citicorp merged with a different bank. So now I think they changed it from corp to group because there was multiple banks.
Right.
So,
but there's another city out there, and I remember it was something for TV I was doing. I forget what it was, but I'm sorry, Mike, I can't remember. But well, do you want to talk? You want to talk about the City Bank? What do you want to talk about, Mike?
No.
Okay.
The stock I own is New Tech Business Services, and it's the symbol's NEWT.
Okay.
And I'm sitting on a nice profit on it, and but I'm getting nervous. I think maybe it's time to take some profits.
All righty. Percentage-wise, how much does it make up of your portfolio?
Well, it's grown to about 8% now.
Okay, that's not too excessive. So let's take a look at the New Tech Business Services Corporation. By chance, you know what they do, Mike?
They're a business development company.
Okay.
They lend to small businesses who can't get bank loans.
Okay. All right. And we did a post this past week. We saw this that banks have, I think it's $17.4 trillion they're sitting on.
Doing that post next week.
Oh, okay. I thought we posted already. Okay, but they can't loan out money, so it kind of makes it interesting for New Tech Business Services that maybe they'll have trouble loaning out money. But let's take a look at the numbers here first to see if it's worth even looking at. Again, New Tech Business Services Corporation, symbol NEWT, PE ratio 11.5. That is good compared to the industry at 14.7. Price of sales is very high, though, 6.8 versus 2.6. Price to book value looks good, 2.3 versus 2.5. And price of cash flow checks in 11.9 versus 25.7. So valuation ratios look pretty good. Wow, I do see you get a 7.4% dividend, and they only use 63% of their earnings to pay that out, so that's a big positive. Sales were up 17.3% year over year, above the industry at 6.3. Earnings per share, they did climb by 152%, about 3 times the industry at 53%. It is a financial company, so no current ratio. Debt to equity 124 versus 158, so that's a good comparison there. Return on equity is 20.9 versus 14.9. Net profit margin, wow, 56.6 versus 17.8. And then receivable turnover is 7.7 versus 0.7. So numbers here looking pretty good. What do you got for the earnings going forward, Chase?
Yeah, just some things I'd want to look at with this business is what does their loan portfolio look like? We always talk about with kind of even with you just brought up with banks having so much liquidity and having a hard time finding places to loan that money. Well, who is New Tech loaning money to? Is it going to be some high risk players? I would want to understand more about their loan portfolio. I mean, we kind of talked earlier in the show about too much in energy. If they have too much in energy, that could be problematic. It sounds like they're kind of like more of early stage business. So my guess is probably more technology. And guessing from the name New Tech, I'm guessing it's probably heavily in technology. So just overall, though, I'd want to understand the loan portfolio. And also, it does say it invests in early stage businesses, both in terms of debt and equity investments. So it sounds like they might have some equity holdings in some of these smaller private companies. So I'd be curious who they own. Right. So just some things to consider if you, as you do hold the business. But looking at
and the other thing I was going to say too is how do they get their capital to loan out?
Yeah,
I know some companies that we own, they actually kind of have a bank now, and they pay like a 1% return, and they loan out for 18%. So you want to wonder, where is New Tech getting their capital loan out? What are they paying for it?
Yep. Looking at the numbers here, though, for you, is the current price $37.62, near the 52-week high of $38.78, and 52-week low $16.24. I go out to December 2022. I see estimated earnings per share of $2.09. Would give us a target sell price of $34.69. So it is above our target sell price here. It might be time to essentially take those profits that you made. But I'm kind of surprised. I see December 2021. So this year, the company's estimate $3.15. I mean, that's a huge fall off to go from $3.15 to $2.09. Kind of curious what's occurring in the business to have such a substantial decline next year.
Chase, I got different numbers here. The earnings you had again was for what year?
2022.
2022. Oh, there it is, 209. Oh, okay. What I was looking at, because I don't think you mentioned it, there's a big drop from 2021 of $3.15 down to 209. Did you bring that up?
That's what I just said.
Oh, okay. I guess I was so busy looking at it. I was so busy looking at it that I wasn't listening to you. I'm sorry. I should have listened to you. But, yeah. So, and that does worry me because, Mike, they're going to have maybe a good year this year, then next year not. What was the target sale price? Because I was not listening. I'm sorry. I'm doing the research over here while you're talking.
Target sale price here, $34.69. So,
okay,
you were focused on that. I had the same conversation that you just had.
So, Mike, I hope we're not confusing here as we're having our conversation here, but I'm going to make sure we get it right. So, obviously, it is a sell. You're right to sell this because it is above the target sell price. And it may go higher, but I don't see the good future for this company. And I guess you made some money on it. So, yeah, I'd say it's time to sell this business.
And also, I like that 7% dividend that they seem to be able to maintain.
But what could happen is that, you sell it now, maybe it goes a little bit higher, but you sell it now, yes, you'll give that 7% dividend, but you'll then have the cash. And what could happen down the road, we'll say a year or two, the stock would drop, maybe back down, and we're just guessing, $25 a share. Now you'll get like a 9% dividend if they didn't cut the dividend. But don't hold a stock just for a 7% dividend, because if you get a 7% dividend, the stock drops by 20%, you're still down 13%.
Yeah, because I don't understand the dividend policy. Are they paying a special dividend, and that's what's elevated that 7%? And going back to that decline in earnings that we just discussed.
We discussed that twice.
Is the earnings, if they decline now, that payout ratio increases. So they might have to reduce that. And I've seen that happen with, real estate investment trusts where people, they love the yield that they're getting on it, but they actually reduce that dividend so they can maintain it. I'd want to understand more about their dividend policy on that 7% yield, because it could be lowered in the future, which would be upsetting if the stock declines and now you have less in terms of the income of the dividend. So just some things to consider if you do decide to hold it there.
Yeah, but I wouldn't recommend.
No, I wouldn't either.
Don't hold it for the dividend. My recommendation, if it came to us, we would sell it. Doesn't mean we're going to turn around and buy something right away, but now you'll have cash to take advantage of any future pullbacks, which again, we think there's going to be a pullback in the future. So we're going to put a sell on this company. All righty?
I appreciate it.
Okay, Mike, thanks for calling. You're welcome. Bye-bye.
Bye-bye.
All right, that opens the phone line, 866-577-2466. 2473. That's 866-577-2473. Let's go out to San Marcos and speak with Phil. Phil, you're in the Smart Investor over at Chase. How can we help you?
Hey guys, how you doing?
Good.
Hey,
How you doing?
Good. Hey, I bought a little bit of Viacom, VIAC, immediately after that hedge fund investor Huang got exposed. Actually, got exposed by Viacom themselves, just around the $40 mark. And I was actually interested in them before because I think they're a target for a merger or acquisition. And I'm kind of curious to get your feed on just the fundamentals.
Okay.
And as far as what you think about them potentially getting merging or getting acquired.
All right. Well, we'll take a look at the company. I know we kind of looked at this as well to buy it. I think it fell.
Yeah, and I forget to. Did it? You said it, Phil. You said it fell to about 40. I'm kind of blanking on the numbers right after the whole kind of fallout. Is that correct?
Yes.
Okay. So it's been kind of hovering around that level since the fallout.
And I remember when we looked at it, Chase, too, and I don't think they've been updated yet, was during that whole situation, they issued more debt and I think either more equity or preferred stock.
I think it was a combination.
And so when we look at these numbers now, because these are numbers ending March 31st of 2021, that new debt may not be in there. So you got to do a little bit of reading here because that won't show up until they report their numbers for June 31st. Then you'll see big change in the balance sheet. So we're going to run over these numbers, but keep that in mind here, Phil, because there could be more to the story than what we're seeing here based on financial statements from March 31st. All right, so look at Viacom CBS, symbol is VIAC. We see a PE ratio of 9.8 versus 58. That's very good. Price to sales 1.1 versus 2.8. No price to tangible book value, but that's the same as the industry. And then we do see price to cash flow is 8. That is good compared to the industry at 14.1. We do see they pay a dividend of 2.3%, only use 22.5% of their earnings to pay that out. That's a big positive. Year over year, sales are down 1.4%, but the whole industry was down 6.4%. Earnings per share for Viacom did climb by 59% when the industry fell by 57%. So you do want to kind of know how they, had loss in sales, but yet increase in earnings. How they do that, was it accounting? Probably. We do see on the balance sheet, current ratio 1.8 versus 1.3. That's positive. Debt to equity 92.8 versus 104.9 for the industry. We do see return on equity looking very good, 16.5 versus 5.2. Net profit margin 11.6 versus 4.9. Receivable turnover is not very good, 3.6 versus 6.3. I wonder if advertisers are not paying here. That could be. And then we do see inventory turnover is 11.8 versus 16.9. Chase, what do you got for the earnings going forward?
I did kind of look this up. It looks like it was announced March 24th. So I don't know if it occurred in the first quarter or if the capital raise is now going to occur after. But the thing is, it wasn't debt. It was $20 million of common stock at $85 per share, which is awesome for them. They got $85 if they didn't do it.
For the company,
because they got a lot more cash than if they had done it at $40. They also did offer $10 million of preferred stock at $100 per share in a secondary public offering. So they raised about, we'll call it about $2.6 billion from that offering. Now, looking at the current price for Viacom, it is still, as I said, around that $42.35. Now, we know it got crazy earlier this year. I remember checking, it was like, $100 a share. I was like, holy cow. It did go as high as $101.97. But as you mentioned there, Phil, with the fallout with the hedge fund, it has fallen quite substantially. But it is still well off the 52-week low of $21.67. I remember looking at this business at the beginning of last year, even around like $17, $18 a share.
Yep.
So even though it's gone way up, we would have ridden it through the craziness up to 100. Yep. But, it's still well off that low. But looking forward to December 2022, I see estimated earnings per share of $4.06. That would give us a target sell price of $67.40. So still some room for appreciation there.
And I did look at the income statement just for the shares outstanding. I looked at the basic weighted average shares outstanding. A year ago, 614 million. It's now 622 million. So maybe this is cooked in there. But you said the announcement was, and it was announcements that they did it or they were going to do it.
I'm not sure, but 20 million share, so it sounds like that could be about right.
No, that'd be I guess that'd be that'd be 8 million.
Okay,
increase.
Maybe they had some buybacks or something last year too to kind of counteract
Yeah.
that. But yeah, I don't know. Some definitely more research on it. And you talked about the merger acquisition of it. That definitely has been rumored, as you've seen a lot of mega deals as things are kind of starting to consolidate in the streaming side. I will say, don't get too excited over a merger though. We've seen what happened with Discovery and AT&T when they announced their business deal. Neither one of those companies really did much after the offering. I mean, initially they did, but then they pulled back very, very quickly. Yeah. So if it's going to be an all-stock deal, let's say, Viacom may not benefit from it. Yeah. If they are acquired in cash, that would be ideal, but it seems like the way that the companies are doing these is by doing stock mergers.
Yeah. Does that help you out, Phil?
Yeah, thanks very much. And I'll see you guys at the workshop.
Well, good. We'll look forward to seeing you Thursday the 24th. We'll see you then.
Okay, thanks.
Okay, Phil.
Right, see ya.
Bye-bye. All right, that does open the phone line, 866-577-2473. That's 866-577-2473. And Chase, you are correct. You brought up the AT&T Discovery merger there. Good deal. But many times on short term, it doesn't pay off. And that's what people have to realize. And again, we always talk about buying businesses. Don't worry because, oh my gosh, it went from, I think 18 hit 33, went back down to 27 or something. That's because I think short term, and maybe people are buying on the rumor, selling on the news, but we don't care about that. We're buying a business, which we think both of those are going to do very well.
A lot of people, I'm going to say a lot of individual retirees held AT&T for the dividend. And when they announced the cut, I think a lot of them sold it, which I think is a big mistake. You still get a very good yield even after they cut it. I don't know if you're going to find a better secure yield than even AT&T's cut. So I think a lot of people made a mistake selling, and I mean we'll see. Yeah, we'll see what happens. But
could have been some funds sold it as well because that cut in the dividend yield. But you're right. I mean, it's still going to pay I think about a 5% yield.
I think it's 4.5%, 5%. I want to say.
Yeah. I mean, and again, people are going to sell them. They might buy back 6 months later, like, oh, that's still a good yield. And again,
I'm looking for yield. Oh, wow, this company pays 5%.
Well, who is it? AT&T. Well, I sold them before. And I think that the companies will do very well separately. And I'm still not sure. We don't know how much they're going to get off that the AT&T shareholders are going to get from the spinoff of Discovery.
Yeah, I mean, they're estimating somewhere around $17 a share, I want to say. So
I think when it's all said and done, you look back at this deal, a year or two later, like, wow. I did pretty good with that deal.
Yeah, So I'm optimistic about it, but point is Viacom, them and Comcast, I think, are kind of the remaining players out there that are rumored to do something because they're kind of going to start getting left behind. Netflix already has a pretty good-sized following. Obviously, Disney Plus now is they merged with Fox. The creation side of Fox, their content and stuff. What was that, 2 years ago now? And then AT&T and Discovery with Time. Well, I guess AT&T's spinning out Time Warner to merge with Discovery. Right. AT&T's not actually merging with Discovery. It's a kind of reverse merger type deal. So there's a lot of action going on in that space, and I think the ones that could get left behind are the smaller players if they do nothing.
Yeah, and what could happen, because I know a lot of companies have a lot of cash on their balance sheet, is that they could be actually starting to acquire companies by cash. But it may not be the big mega mergers. It could be the smaller companies they're buying.
And I'm going to give out a little tip here.
Yeah.
One company we're looking at as well that doesn't get as much.
We're going to give away a company we're looking at?
Yeah, I'll give people a
little
tidbit.
We'll be nice today.
It doesn't get a whole lot of love in the news, though, it seems like, is Fox. And it's interesting, they lost a lot of the content when they sold 21st Century to Disney. But, I mean, they still have, Fox Business, Fox News. They have Tubi is another item, and they have the content.
Right.
And I think somebody's going to want that content from Fox.
Yeah.
And I'm just curious to see what happens with that business as well, because it seems like that's another one that could get scooped up, but it's not being talked about as much.
And with your Republican or Democrat, the politics going forward is going to be big news, I think, for the next few years. And they're a big part of that on one side. So I think they will benefit on the advertising from that side. So
hey, if you don't want to pick a party, AT&T, Time Warner, they own CNN. So, hey, you can buy both, and you're not picking a party.
There you go. I like that. All right, phone number is 866-577-2473. That's 866-577-2473. Let's go out to El Cajon and speak with Art. Art, you're in the Smart Investor with Brent Chase. How can we help you?
I'm fine. Yes, I have a question for you on one of my stocks that I picked. It's called QYLD.
Now I show that's the Global X NASDAQ 100 covered call ETF. Is that what you hold there, Art?
That is correct.
Okay, all right. So it's not really a stock. It's more, well, it's an ETF, which is exchange-traded fund, so it's more of a fund. I couldn't pull up much detail on it. Now, one thing that I don't like seeing is that, and I think we've talked about one like this before, was a covered call. And what you have to understand, what they're doing is that they own a stock, and then they'll sell the call option on it for a future price. Yeah. Now, what that does, it gives them some income stream, but what it also does, like say you have a stock that they hold at $10 a share, they sell a call for $1 a share, the stock could go up to 15, and all they're going to get is 11. So, I actually tried years ago the covered call strategy because I thought it made some sense. It actually hurt my performance because I got things called away from me that did far better than what I got for that premium. Do you have anything on the fund, Chase?
I was going to say, too, in calls, I'm trying to get this right in my head, is when you sell the call, that means that you are basically looking at if it goes, you don't have any downside protection.
Right.
So, I mean, the thing is with the NASDAQ, if the NASDAQ falls, you're going to have risk there, and you limit the upside potential. But I do see the yield right now is like 12% on this, so they're selling those calls. I'm curious what levels they're selling the calls at. Yeah. It's definitely more of a complicated strategy, but I do worry a little bit. The NASDAQ's gotten very, very expensive, that you don't have that downside protection to this product.
Yeah, that's a good point you bring up because, again, you do get that extra premium, which say you sell that, I'll use that $10 again stock. You get a $1 premium. Well, you got a 10% downside protection, but after that, there's nothing there. And I'm assuming the NASDAQ 100 is probably the top 100 NASDAQ stocks, which would include, I'm sure, like Netflix, Tesla, all these other ones that are very, very high, which selling the covered, the premium, I don't think it's going to cover anything. I've tried this strategy. I think I did it for like 2 years. I said, no, this does not work long term. It looked great short terms at times, like, wow, I'm making all this premium, but then it's like long term, you don't make money. So I would recommend to get out of this fund. It just doesn't make much money for you.
Yeah.
All right, Art.
Okay, thank you very much.
All right, you're welcome. Bye-bye. All right, that opens the phone line, 866-577-2473. That's 866-577-2473. That's two funds we had to work on today.
Yeah, and I'm going to say it's interesting. I go back to like 2013 when this fund first started. Is the price was $26 a share.
Mm-hmm.
It's now $22 a share. So you've gotten income from it. But I think by them selling the calls is you don't get the upside. So the NASDAQ's done phenomenal since 2013, but you lose out on that upside because they have to sell away the QQQ is what I'm guessing they're buying. And as I said, with the downside, I mean, this fell as low as, what is this, $18 a share back in COVID. So, I mean, it can drop, and then you lose the benefit of the income. So I do worry about products like this.
Yeah, and that's exactly why I didn't keep doing what I was doing, that strategy, because it looks good for a while, but then you made a great point. Now, probably they weren't using those call strategies. Instead of being $26 a share, you said now?
22.
22 was 26.
It was 26.
26. That share price could have been 44 or 50.
I guess since 2013, the NASDAQ's definitely more than doubled.
Yeah. So I just don't like these special things that we do. I mean, we do, hedging things. We do stuff like that. But to try to get a better return, generally options are not going to give that to you. They'll give you some, I got this premium coming in, which, by the way, if it's not an IRA, it's taxable as ordinary income also. So, alrighty. Phone number is 866-577-2473. That's 866-577-2473. And Chase, we're talking about the options, these crazy things going on. This is why we do the workshop. The next workshop is going to be June 24th, 6 o'clock. It will be at Ale Smith Brewery right off of Miramar Road. Now, at the workshop, we're going to show you how we managed our clients' money for the past 40 years, my own money for the past 40 years, how I've been successful investing. And again, we talk about these things that we just talked about with the option strategies, things not to do when it comes to investing. We will go over all the financial fundamentals that put your mind at ease when investing and keep you on the right course for the long term. And again, we talk about this correction coming up. This is when you want to really be on track and be doing what we call being a smart investor, not just buying hype and buying crazy things. We'll also go over all the mistakes that investors have made for years, and we don't want you making those mistakes. I want to show you what they are so you won't make them. The workshop, we're about halfway full now, so it is seating is limited there. But what you can do is I recommend sign up now. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. You can call the office and speak with Brianna. That number is 858-546-4306, 858-546-4306. Get you signed up. It is free, but you got to register, and we look forward to seeing you on Thursday, June 24th at 6 p.m. at Ale Smith Brewery. All right, let's go back to the phones here. Let's go to San Diego and speak with Guy. Guy, you're in the Smart Invest Show, Brent and Chase. How can we help you?
Hi, guys, and good morning. Thanks for taking my call.
Sure, thanks for being there.
So me and my twin brother are, well, first of all, I'm a novice, a newbie.
Okay.
But me and my twin brother are having a little contest because he's into that crypto stuff.
Okay.
And I'm not too much of a believer of it. But I recently purchased SENS, and I wanted you to let me know how that is and for the future.
Okay, and Guy, very important. Did you set a timeline on when the contest is over?
We set it June, 1 year from now.
1 year, okay. A little bit short. I was going to say you might want to say, okay, well, let's come back and look at this in 2026. You'll probably kick his butt. But in the meantime, he may beat you because, again, it's just, we don't even invest money for a year because it's just too speculative. I mean, you could do well. It's more of a guessing game. We'll go over the numbers here for you. And it's Sensonics Holdings Corporation? Yeah. So we'll go over the numbers for you on that.
And when did the bet start? Did it start when Bitcoin was around 64,000, or did it start?
No, it just started 2 or 3 weeks ago.
Oh, that's too bad. You could have gotten a huge head start there.
Right. Well, the only reason that I picked that one is because I am a diabetic, and that's a diabetic continuous reading.
Okay.
Type of thing, and I was told when you buy stocks, buy something that you're gonna use.
Yeah, that's the start of the research. I mean, it does help when you do that. And we're going to go over the numbers here for you, and I'll explain why that's the start of the research. Because, yes, buy something that you know and you use, but don't buy it just because of that. Because you could buy a company like the Polaroid camera, which a lot of people use the Polaroid camera, and that went bankrupt. So,
yeah, I was going to say, you definitely want to buy something that you use, but as Brent said, this is the start, because you don't want to buy something that you hate and you don't use, because that's a terrible idea. So.
Right.
Yeah. So, all right. So let's look at Sensonics Holdings Incorporated. Symbol is SENS. Here's a problem, Guy. No PE ratio versus 42 for the industry. That tells me they're making no money over the last 12 months. Price to sales, very high, 221 versus 7.4. Price to book value, not material, which means you take away all the liabilities actually exceed the assets, so there's no value to this company. Price of cash flow, not material versus 28. Now, looking at the revenue growth, it's actually they've lost 59% year over year when the industry grew their revenue by 22%. Earnings for the company fell by 85%. Industry grew by 63%. Looking at the balance sheet, we see a current ratio of 12.2 versus 2. That says they have a lot of liquidity, but there's no debt to equity. While Chase looks at the numbers, I'll see if they have just no debt or there's no equity there at all. We do see return on, I think they have no equity because there's no return on equity here. Net profit margin, oh my gosh, they lose 4,900% versus a gain of 17.4. Receivable turnover is 5.8 versus 6.1, and inventory turnover 0.9 versus 3.0. I know what the number is going to be when Chase runs them over, but we'll make another comment as he finishes up on that.
Yeah, so if I look at the current price here for Sensionics, it's $4.01. 52-week high is $5.56, and wow, 52-week low is 35 cents. Now, unfortunately, I go out to December 2022. The company's still not estimated to make any money, so I can't get a target sell price off of it. I will say this company was up 11% yesterday. So, I mean, this is one of them where, you could look next year and you could be winning because it's more of a gamble here. We don't like to take chances on things. We like to kind of find good, steady companies that have a lot of kind of data out there. This seems like it could be a big hit or it could be a flop.
Yeah, that's what I was going to say is that this company is speculative just like the cryptocurrency, the Bitcoin is, because there's a lot of speculation here. And, again, this could do extremely well because maybe they hit some big factor and the stock goes up, 200%. Or it could be gone in a year because of the fact that they just didn't do well. So,
and you said you are diabetic there, right, Mike? Or Guy, excuse me.
Right.
Do you use their glucose monitoring system?
No, I do not. I don't think it's got the FDA for the 12-month reading yet.
Okay. So that would make sense then if it is coming out. But I know they're going up against some big names there, and obviously Dexcom and I think Medtronic are other names in the diabetes space. So I'm curious if they're direct competitors with them. Maybe they're an acquisition target down the line, but it's a lot of speculation for this business.
And Guy, here's a big thing. You said they don't have the approval yet. If they get that approval, the stock could skyrocket. Yeah. If they don't get it,
that's why I took a chance. But it sounds like with all the numbers you said, it's going the wrong way.
Well, and that's the tough thing is that the numbers. It's very hard with biotech and healthcare companies, is because analysts like to kind of have a good basis of things. Like if you look at a food company, you can kind of project things out very easily because you know what's going to happen. With this business, you don't know what's going to happen. You don't know if they're going to get approved or if they're not going to get approved. So it's much harder, and that's really where the gamble comes in with biotech is it all hinges off what the FDA says and how the research goes, and it's kind of a form of gambling a lot in this type of space.
And that's why, again, if they get that approval, the stock you'll do very well. They do have a lot. I looked at the total liabilities, went from $84 million up to $381 million. They do not have any equity, have a negative equity of $185 million. As an investment goes, this is not a very good investment. It's a very speculative investment. So you're kind of both doing the same thing. You're both speculating just on different financial instruments, we'll call it. So. But if you listen to the show more, Guy, you'll hear some other ideas on actually companies. We talked about Ford this morning. We'll talk about different companies. You can also sign up for a newsletter. I think you said you're new to investing, so go to our website, smartinvesting2000.com.
Right.
We do the newsletter. We got the workshop coming up, so a lot of different things to try to help you out as an investor. But again, somebody on Bitcoin, they could just blow us out of the water over the year. What we look at is more of like long-term investing, and I've been doing this again for 40 years, is my thing was never to lose people money, and we've made a lot of people very wealthy over time is the big factor there. All ready?
Great. Well, thanks for your time, guys.
You're welcome, Guy. Have a good one.
Take it easy.
Bye-bye.
I'm just giving away too much today, but
you think it's Christmas here? What are you doing?
We were talking to a guy here about using something that you know and use. I was reading a conference call yesterday for a company we're looking at. I'm not going to give away the name.
Right, thank you. All right, gosh.
It is again a restaurant company, and I was like reading, and I was like, it's around lunchtime. I just got so hungry because I love the restaurant, and I was like, oh man, this is tough. The point is, it's like I wouldn't buy a restaurant that I go to, and I'm like, this place is terrible.
Yeah,
you don't want to do that, no matter what the numbers look like. You don't do that, but I thought it was a good story.
And it does make investing a lot better when you actually like the product and you use the product. It makes you feel good, like, yes, I own this business, and it's doing well. And again, don't buy it just because you use it, but you look at both. And many times we'll buy a business and we'll say, yeah, let's start using it. We'll use the product because it's so good. And then the other side, too, we'll stop using it if we sell the company. But it does make a difference. But don't ever invest just because you like the product, because that could be a problem. So
you want to like the product and like the numbers.
Yep, exactly. All right, phone number is 866-577-2473. That's 866-577-2473. Let's head up to Huntington Beach and speak with William. William, you're on the Smart Investor, Brent Chase. How can we help you?
Good morning, gentlemen. What a great segue, because you just mentioned about buying stocks in a product, but I'm calling about a stock in a company that I go to, and I'm sure a lot of your customer or your listeners do as well. It's Walmart.
Yes.
I don't own it, but I own Target, and I've been very happy with it over the past year and a half. I'm just not sure if the Walmart numbers look as good as the Target numbers.
I think we have the same. I'll let you say.
Okay. So the big question is, you go to Walmart, do you go to Target?
I go to both for different things, and I actually personally do have a preference of one over the other, which is kind of why I'm calling.
You like Walmart better than, huh?
I like Target better. I think they're cleaner. I think they're set up better, but I think they have slightly different markets. Yeah. And with the small businesses being shut down over the past year, I would have assumed both would have done rather well. I'm just not sure one did as well as the other.
Yeah, Target actually did very well.
Well, and Walmart was a little bit ahead of them on the technology side, but Target really revamped things. Gosh, I remember looking at Target a few years ago, and we didn't have cash available to buy it, and we had a lot of businesses that did very well. But I remember looking at it, and it just made sense. It's a great company, and all of a sudden, they were able to get that technology revamped, and they've done very well.
Right. All right, let's look at the numbers on Walmart here for you. Symbol is WMT. And I'm kind of excited to look at it because over the years I've held Walmart at different times. We do not hold it now. PE ratio 32.7. That is above the industry at 32. Price to sales 0.7 versus 0.55. Price to book value 8 versus 9.2. And then price to cash flow checks in at 16.8. That is well above the industry at 10.2. You look at a 1.6% dividend. They use 50% of the earnings to pay that out. Now, sales for Walmart have climbed year over year by 5.3%, which is above the industry at 3.3%. However, earnings per share for Walmart fell by 18.2%, which was a larger decline than the industry decline of 17.9%. Look at the balance sheet. Got a current ratio of 0.95 versus 1. That's okay. Debt to equity is 61.8 versus 83.5. Return on equity, very good for Walmart, 16.7 versus 14.8. Net profit margin, and these are retailers, is very low, 2.2, but the industry average is 1.7. And then with a receivable turnover, 104 times versus 58, and that's over the last 12 months. And then inventory turns are at 9.6, about the same as the industry at 10.4. Very excited to hear about the earnings going forward. Why are you all with us smiling?
I was just thinking about my preference here. I mean, my fiance hates Walmart, so I don't go there. One of my best friends hates Walmart, so I've gone to Target more lately, and it's closer to me. But I will say Walmart has better 4th of July shirts, so I always go to Walmart around 4th of July because they have the best ones.
We won't tell her. Hopefully she's not listening.
But I'm not going to buy Walmart because I like their 4th of July shirts. So let's look at the numbers here.
Right.
Current price $140.75. 52-week high, well, that's $153.66, and the 52-week low, $117.01. If I go out to January 2023, I do see estimated earnings per share of $6.26. Would give us a target sell price of $103.92. So it sounds like you like Target better to shop at, and I don't think I'd buy Walmart stock at this time either.
Yeah, and the thing is
interesting.
And I figured that Walmart is overpriced, and my guess is probably Target's overpriced as well. So what you probably should be doing, and we got another caller behind you, so I can't do Target for you, is look at Target because I think Target's overpriced.
Yeah, and I will say the other thing is I don't want to spend too much time here, but the earnings, they are only estimated to grow 4.8%, so it's trading at a lofty valuation there, and there's not much earnings growth left in it. So I don't like Walmart at these prices. I'm sure Target's kind of similar, and you've done well with it, but I think there's going to be better opportunities out there.
Yeah, I'd say maybe call back next week, and we'll take a look at Target for you.
Absolutely. Very interesting, gentlemen. I really appreciate the analysis. And, wow, you really live up to the name of smart investing. Thank you very much.
All right. Thank you, William. We appreciate it. Have a good one.
You too. Bye-bye.
Bye-bye. All right. That does open the phone line, 866-577-2473. That's 866-577-2473. Let's go out to San Diego and speak with Joe. Joe, you're on the Smart Investor Brent Chase. How can we help you?
Hey guys, how you guys doing?
Good. How you doing?
We're doing great out here. I was just interested in what your thoughts were on Tesla. I currently own some, and it's just definitely about 20% lower from what I bought it at. And just kind of wondering what your thoughts are on that.
You said you're down about 20. What'd you pay for it, Joe?
I think it was like $7.28 a share.
Okay.
So kind of when it was on its up.
Yeah, I mean,
And it sounds like you're kind of driving around right now. Are you driving around in a Tesla or?
No, actually, I'm not. I've got a Durango.
Oh, okay.
Okay. Well, let's take a look at Tesla. And again, we've not got a call on Tesla in quite a while, so I'm kind of anxious to kind of look at the numbers again. Their symbol is TSLA. We do see a PE ratio of 614 versus 73. Price to sales 16.4 versus 2.9. Price to book value 27.7 versus 7. Then price to cash flow 161, more than 10 times the industry at 15.7. We do see that the sales have risen by 38.1% year over year. That is better than the industry decline of 6.2. Earnings per share for Tesla, they have gone up by 748 versus 2,914 for the industry. So I'm surprised they've not done as good as the industry has. And also, too, I know a lot of those earnings are coming from tax credits, not from operations from the business. So you got to keep that in mind. I don't think they'll be changing with this current administration, but you still want to know where their earnings are coming from. Debt to equity looks pretty good for Tesla. It's 47 versus 156 for the industry. Current ratio looks good, 1.7 versus 1.3. So we have seen a improvement in the balance sheet of Tesla over the years here now. Return on equity is 6.9, not quite as good as the industry at 11.1. We do see a net profit margin of 3.5 versus 4. And then we see receivable turnover is 22.7 versus 3.3. Inventory turnover is 6.6 versus 8.9. Chase, what do you got for the earnings going forward?
So current price here for Tesla, $609.89. I mean, 52-week high did hit $900.40. 52-week low, well, that was $181.71. Or no, excuse me, $181.70. I go out to December 2022, though. I see estimated earnings per share of just $6.23. We use 16.6 as our forward multiple because that's the long-term average for what earnings normally trade at. If we use that multiple, we get a target sell price of $79.51. And this is one thing we know about Tesla. It's very, very expensive. People like it because of the estimated growth, but I do think people really did undersell what the competition was going to do. And I mean, I think a lot of people are surprised by what the traditional auto manufacturer kind of come out with, which I think has started to ding Tesla's stock price. So it's still very, very expensive.
Mm-hmm.
I don't know if it's going to fall down to $79 a share, but that is what the long-term valuations would put it at.
And there's a lot of things behind Tesla. You got the CEO Elon Musk, who is on TV. They seem like all the time doing something. Now you got the Bitcoin in there, which you don't know if he likes it today or doesn't like it. You know, there's a lot of things that goes on with this business that take away from what the business really is. It's more of a speculation because it is a great car. I mean, I know people have them. They love them. I think they're done very well. But as a valuation for a business, it's just not there. I mean, because GM, we talked about Ford earlier in the show, that they've got some great EVs now. So Tesla, it's more of a speculation here of what the stock's going to do. And I think you said you're down 20%. It's always hard to sell a company when you're down 20%, but I can't give any reason to hold on to it. And it's very possible you sell it here and it goes back up to 700-800. But I know if you came into our office to manage your money, we would recommend that, yes, we sell this company. Even though it's a great name, great car, it just is not justified for the current stock price. Does that help, Joe?
Yeah, it does. I appreciate your time, guys.
All right. Well, stay tuned and let us know what you do there. All righty?
All right. Have a great day.
You too, Joe. Bye-bye. Bye. All right. That opens on the phone line, 866-577-2473. That's 866-577-2473. Let's go out to San Diego and speak with James. James, you're on the Smart Investor Brent Chase. How can we help you?
Interested in Microsoft. My money manager said that they're going to be taking over market dominance over Zoom with their Microsoft Teams. I was kind of curious what your guys' thoughts were on that.
Now, you said market dominance, or are they taking over Zoom?
They're going to take over the market share of it, is what I'm saying.
Okay. I've not heard that. I'm not sure.
Have you used Microsoft Teams, James?
Yeah, I use it for my company, and a lot of my clients use it as well. Okay. So I was kind of seeing it as well, but I was a little bit shocked because, Zoom is definitely the brand name.
Yeah. And I do think it's I don't know how big that space is going to be, and obviously I know WebEx is in there as well, but I think there was a lot of kind of hype around the video conference calls last year. Even if they do take over as the market leader, I don't know what that's worth, and it's, I think, really going to be a small part of their business.
And I think if they were to get into that business, I mean, I do believe Zoom has a kind of cornered the market, so to speak, on it. How much is Microsoft really going to make off it? That's really going to move this big company that has, earnings that are just huge. Yeah, I don't think it'd be a game changer for them, especially as Chase said, with the declining use as the economy's opening here. I think we'll see declines in Zoom or what do you call it, Team for Microsoft?
Microsoft Teams. Yeah.
Microsoft Teams. I just don't think it's going to be a great business to get into. I think it's behind the curve or behind the.
I mean, I'll point out, too, is Microsoft Teams is already baked into it. Zoom is about a $100 billion market cap, which I think is way too high for even what Zoom should be worth. Is Microsoft's over $1 trillion in terms of its market cap. So if Microsoft Teams, what is that really going to be worth? Maybe, $50 billion, let's say? Or some of that's already baked into it. I don't think it's going to move the needle too much in terms of its stock price.
And we do have Cisco out there with WebEx is what they own.
Yeah.
I just don't think they've been sitting their hands saying, oh, we're not going to do anything. I think they've probably been upgrading their system, trying to do things to really enhance what they have. So they're a player in there as well. Not a strong player, but they might come in. You never know.
Yep.
So I just don't see this moving Microsoft to any big degree. So, all right, James.
Thank you, guys.
All right, thank you. Have a good one. Bye-bye.
I was going to say real quick, too, is just, I mean, Microsoft is a great company, and, I watch Stuart Varney a lot in the morning on Fox.
He owns it.
He owns it. He owns Microsoft. But, I mean, I look at the valuations on this thing. It trades at $257.89. Next year, they're estimating $8.35. I mean, that gives a target sell price of $138.61. So, I mean, at these levels, that means it trades at a forward PE of 31.
Yeah.
I mean, it's not inexpensive.
No, it's not expensive at all. And there was years past where the stock didn't move for years, and the same thing could happen. It's a great company. It's got some great products. It's got a great executive team, but the stock may be bouncing around 200, 250 for maybe 5 years. I mean, who knows? And this is one of the growth companies we talked about in the beginning that it's done very well over time, but nothing keeps going up every single year, and no matter what they do. So be cautious.
Yeah.
Yeah. So, alrighty. Workshop one more time. It is going to be Thursday, June 24th, 6 o'clock at AleSmith Brewery, right off of Miramar Road. If you want to sign up for that workshop, go to our website, smartinvesting2000.com. That's smartinvesting2000.com. We're going to show you everything we do. We're going to talk about target sell prices, target buy prices, financial statements, mistakes that you may have made in the past, mistakes you could make in the future if you don't know about them. We'll go over all this. It is a free workshop, but seating is limited. You have to sign up. Again, go to the website, smartinvesting2000.com. That's smartinvesting2000.com. We're looking forward to seeing you there. I got some great beers.
Yep. Looking forward to it.
Yep. All righty. There's Frank Sinatra for thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used on investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And visit our website. A lot of information there. smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information on investment tips, go to our Facebook page, Smart Investing with Brent Chase Wilsey. Today's show is sponsored in part by Thomson Reuters Refinitiv. Closing song Frank Sinatra's My Way is performed by local entertainer Roman Palacios. Thanks for listening to the Smart Investing Show. We'll talk next week.
And may I say, not in a shop.
This program is sponsored by Wilsey Asset Management.